Welcome back. Let's discuss all things bond market with Jeffrey Sherman, DoubleLine Capital Deputy Chief Investment Officer. Jeff, long time no speak. Good to see you.
Yeah, good to see you, Wilfred.
Let's start with the big story of the week, even though Rick just told us it's not the big story of the week. But are you surprised markets haven't reacted more to Lisa Cook's firing, or are you unsurprised?
Well, I think it's this thing where the market has slept off a lot of the news when it comes out of this administration. But I think it's, we would expect it to see a little bit sharper movement. You did see the initial kind of visceral reaction to markets where rates kind of went up a little bit. You saw some softness in the dollar where there's just this questioning of authority and autonomy from the Fed. And will the president and the administration get their way of, just trying to stack the Federal Reserve Board of Governors with folks who are going to be significantly more dovish and try to facilitate that rate cut. But again, we were a little shocked to see that the market didn't respond a little bit more. But obviously, as trading went on throughout Monday, it just essentially reversed. And so I think at this stage, the market is so wedded to the Fed cuts. I think they're just really focused on Jay Powell's speech from last week, where he didn't really assure a rate cut, but he said he's opening the door and there's the ability for them to move in that direction. I think this is what the market's been wanting, really for the last month or so. But when you rewind the clock, Wilfred, and you look back, and let's just use like the 2-year Treasury, for instance, we're really trading, kind of at the lows of the year for the 2-year Treasury, hence price in some more of those cuts. But when you go back to where you saw, let's say late last year when we were rolling into that election period, that's where rates were really at these low levels. And so when I say the rates, I'm talking about that front of the curve, which is talking about Fed cut pricing. But I have to remind everyone out there that we also have to take it for a grain of salt right now, because we get the jobs data next week, the following week we get inflation data, and it's really going to be those things which I think drive the Federal Reserve in the direction of whether or not they're going to deliver a cut the following week. But when I talked about rates, I just spent this time talking about the 2-year, but it was that back end of the curve that was the kind of more sharp response to this headline news. And so that is potentially, pursuing a more dovish policy while we're dealing with really the supply of treasuries that are coming due to the fiscal policies and a lot of the uncertainty on that side. So in general, what you have is this, there's something for everyone. Do you want rate cuts? Look at the front of the curve. If you're worried about kind of those longer term implications, look how the back end of the curve has been responding really over the course of the last month or so.
Well, let's talk about that a little bit. And I know it was a few months ago, but clearly Treasury Secretary Scott Bessent kind of spoke about trying to do more short-term issuance rather than long-term. Is that going to work, or are you implying that because of the amount of debt that comes due over the next couple of years, that long-end rates are going to rise regardless?
Well, it's hard to say regardless, because at this point, obviously, the economy matters still. And so assuming that we stay kind of in this area and we go back to kind of this potential growth rate and the, call it low 2% real GDP growth, then I would agree with you that just this amount of supply of treasuries out there. But if you have a Fed that is pursuing a dovish policy, and while we're still getting this kind of uncomfortable levels of inflation. And again, we're not talking about the 9% inflation we experienced 3 years ago, but significantly above the Fed's target. Then ultimately, I think the bond market will sniff this out and say that, hey, you can't be pursuing these policies, and we will make it more punitive as investors for Treasury and issuance. So for all the talk the Treasury Secretary has done about getting the 10-year yield down, he hasn't been very successful thus far. And that's because those are market forces which are beyond his control. Now, the one way that the Fed could ultimately control, the back end of the curve is to get someone, or appoint more folks at the Federal Reserve Board of Governors that ultimately want to do yield curve control, right? They want to do quantitative easing, and they want to try to manage that. And that's not a great policy, of course, especially when market forces are going in the other direction. But it is potentially something that's on the table that investors have to think about when we go to next year and we have a new Fed chairperson.
Yeah. At what point, Jeffrey, in this process that we're going through and questions surrounding Fed independence, do you say, you know what, I'm going to diversify away from U.S. bonds for a bit. I'm going to look elsewhere around the globe that's offering better yield, maybe a little bit more credibility when it comes to fighting inflation. Are we there, or at what point in the process do we get there?
Jeffrey, there's some nice yields on offer in the UK. Just if you can Help us out
Yeah,
there.
Wilfred, there has been for a while. The problem with the UK and the US, Wilfred, is you're well aware, the rest of the world is converging to us, right? And so this does, Leslie has a great point there on that. The UK is not without its own fiscal issues as well. But in general, if investors are looking to make that bet, like I don't want to go to Japan. I know you can get, you can buy long-term JGBs there. It gets you in the 3 yield. When you hedge the currency back into dollars, you can get close to a 7 yield. But that's fraught with lots of volatility as well. And so, Leslie, if you're looking at that type of trade, and something we've done at DoubleLine over the last couple of months, is we've actually started to buy local currency emerging market bonds. And so we haven't really went in size in this. We've started to kind of nibble our toe in the water there. But we think that area of the market, because as you point out, Leslie, there's also yield that accompanies it. Yes, there are risks out there with those trades. But in general, you're talking about things that, without having to deal with all this kind of currency hedging and stuff. And yes, you're taking the currency risk. You can put together a nice portfolio of local currency emerging market debt that actually gets you in kind of this low 7% range. And you say, okay, well, that's significantly better than the US. But as our emerging markets portfolio manager said at our asset allocation meeting 2 days ago, was that a lot of our policies in the U.S. are looking EM-like, right? We have state-owned enterprises now. You have the government taking pieces in Intel. We're talking about privatizing, parts of our markets. And so you're starting to see some of this convergence. And so maybe that means that U.S. yields should be a bit higher if we're going to pursue those type of policies as well. So I think it's a great point, Leslie.
Just quick final question, Jeffrey, having mentioned the UK in jest, but a serious point, whether it's UK, whether it's Japan, maybe it's France, if you see one of those bond markets like crack in a really big way in the next 6 months or so, will that affect US yields at the long end or not?
Well, I think you've seen still a coordinated policy for so long in the developed world. The U.S., the global interest rates in the developed world have been highly correlated. And really the one break there was Japan, right, where they did not want to pursue the rate hiking policy. And so it kept their yields depressed for a very long period of time. And so you've seen as they've started to try to release that policy that the market forces have taken hold. And so I do think there is some correlation there because, again, investors are going to see, even though we all have our own challenges, there is some fungibility when you talk about the global sovereign world. Yes, there still is the rule of law. There are these things that kind of keep you in the safety, whether it is the UK, whether it is France, whether it's the US. I would be avoiding the JGB still at this point, just because, again, that's the one central bank that likes to throw curveballs, right? They're the ones that don't like forward guidance as much. In fact, I feel like a lot of times the BOJ is trying to trick us in the market where they're leaning one direction and then do the opposite. And so I think what you're seeing now is letting market forces take hold. And if that's indeed the case, without managing that with the supply of just global sovereign debt around the world and high debt to GDP ratios, and again, we don't have this controlled inflation rate, that means ultimately rates probably should be at these levels, especially in the back end, if not a little bit higher than what we see today.
Jeffrey, great to catch up again. Thanks so much.
Welcome back, Wilfred. Good to see you on this side of the pond.